So the debate has been raging ever since lockdown or hard lockdown about office space, the future of office space. Will we see an accelerated or a bigger work from home population after COVID-19 has ended? And there are the skeptics. They believe that by and large people will go back to the office and life will continue as normal because people need people. They need to collaborate. We can't do everything online. Then there's the other camp, which I'm firmly in, saying that, well, we know that there's been a trend towards greater levels of work from home that's been emerging for a few decades now, ever since technology, information technology started improving at a faster pace. And I believe that this trend will be accelerated post-COVID. That doesn't mean that everybody is suddenly going to work from home. A lot of office space still exists. The infrastructure is there. The space is leased or owned. We'll use it for the time being. But I believe that many of us who go back to the office won't be there as often as what we used to be. We'll be working at least to a greater extent part-time from home, and a greater portion, I believe, will be working full-time at home. Companies are under financial pressure. Office space is costly. So in many instances, work from home is a cheaper option for both the employee as well as the employer. But we don't have concrete evidence yet of just how strong the trend is as we emerge from COVID-19. Well, we're not quite there yet, but the vaccines are coming and we're getting back to some semblance of normality. But there are patterns in much of the data that suggest at least that the home has become far more important for households. And there are also the trends that point towards sharp weakening in the office market, whether that is from work from home or because of job loss in the office-bound services sectors. That's tough to tell because we know there has been a lot of job loss in these sectors. But the patterns emerge, the strong home priority emerge in residential market-related data as well as retail data. Now, yesterday, February retail sales data came out, and when we look at the overall figure in real terms, inflation adjusted, it was quite positive. Well, it was low positive, but it's got back into positive territory, which is quite exciting after the dips that it took. Plus 2.3% year on year in February. I'm going to smooth it out a little bit by using a 3-month moving average. So for the 3 months to February, we're still in slightly negative territory for overall real retail sales, minus 0.9%. But that too is edging up towards positive territory slowly but surely. When we look at the categories, the main categories of retailers, according to Stats SA, there are quite big divergences. The stable crowd were the ones that weren't really locked down during the hard lockdown of the second quarter last year. Pharmaceuticals, medical, healthcare type products, those retailers, plus 3.7% year on year for the 3 months to February. General dealers, the general groceries and food shopping, plus 0.2%. Also didn't dip very much in the lockdown phase and now isn't growing very much. Very, very stable. The weak ones have been textiles, clothing and footwear. Actually produced some positive growth, plus 1.8% year on year for the 3 months. But after a big struggle, that category dipped sharply during lockdown. It was almost totally locked down and has really struggled to come back. Specialized food, beverages and tobacco, minus 8%, also not that lucky. And then the other category, it's a wide variety, everything from stationery to various personal goods to jewelry to bookshops, many types of retail put in there, minus 23.6%. A large chunk of that retail non-essential items. So what's really outperformed? It's those retailers directly linked to the house, to the home. Household, furniture and equipment and appliances, plus 12.3% year on year. Very strong real growth rate. Hardware, paint and glass, the DIY and the additions and alterations crowd, plus 9.6%, another very strong figure. The directly home-linked retail categories have been doing very strong. Why shouldn't they? The home has become more important. We're spending more time there. We're working there. We've been educating kids there. It's not just the place that many of us come to sleep anymore. It's far more important than that. So make it more comfortable. Get new office furniture, whatever the case may be. Improvements were in order. And that happened as soon as the hard lockdowns came to an end. We see some strengthening too in Stats SA building stats of additions and alterations passed. up in square meterage by plus 9.11% year on year for the 3 months to Feb. Hasn't been positive for a while, going into positive territory. More additions and alterations to home. That's becoming a priority too, it would seem, from those numbers. And then if we look at the FNB estate agent survey, we see that the estimated percentage of sellers selling in order to upgrade to a better home has increased quite significantly too, from 10% of total sellers back at the end of 2019 to 17%. This has become quite a strong number. So that upgrade becomes a priority for some of the affluent, I would believe, that need a better home, or think they need or want a better home because they're spending more time there. I think there's a portion of that in this estimated number. So the home has become more important. Residential property figures have been telling that. The residential market's been doing very well, but the retail sales numbers have been suggesting that as well. Other retail sales numbers, not linked to the home, but linked to getting us out of the home, also tend to point to that story. And what do I mean by that? Well, fuel sales, travel, getting out, going to work, going to the office, minus 17% year on year down, despite fuel prices having started to rise in recent months. That's a weak number. Restaurants, coffee shops, and takeaways retail, minus 27.4% down year on year. Hospitality and tourism accommodation revenues, minus 73% down year on year. Some of this because of social distancing requirements, hampering capacity. Some of it, I believe, also due to weak income growth from the household sector side, and lack of weak consumer confidence, fears for the financial future, given the deep recession and the uncertainty, the perceived uncertainty that it brings. So we're not getting out and about. We're not going places very fast, are we? Then there's the office space numbers. We've seen supposed national vacancy rates accelerate to above 13%. That's a very weak number. We've seen in the FNB property broker survey, market activity in the office sector on a scale of 0 to 10, they're rated at 3.49, down from the second quarter's lockdown quarter of last year where it was 3.7. It's got even worse. The vacancy index, where we asked them to give an idea of whether they believe vacancies have risen, dropped, or stayed the same over the past 6 months, very strongly biased in favor of rising vacancy rates. On a scale of minus 100 to plus 100, the plus 100 being the strongest rise in vacancy rates, it's at plus 56.4. Far stronger than the industrial vacancy index rating, far stronger, far higher than the retail one. So the brokers pointing towards sharp increase in office vacancy rates still in the first quarter of this year. So that's the evidence. It's not conclusive evidence yet. The residential market, we know, has had strong mortgage growth. The estate agent surveys are pointing towards selling in order to upgrade. The building stats are pointing towards growth in additions and alterations plans passed. And retail sales are pointing towards home-related retail sales doing particularly well, and non-home related, or those that take us out of the home, doing particularly badly. That's the evidence. It's not conclusive, but I do believe we'll see more of these relative performances in the coming months. It's not that everybody will stay away from the office once COVID-19 has been more or less resolved. Many will go back to the office, but I think they will spend less time there, and the long-term trend towards greater levels of work from home will be accelerated going forward, I believe.